It's great to be back here in Berlin and with many of you that we have seen before. And we have 34 minutes and 54 seconds. So Jochen, please keep it short. And so what I wanted to focus on is actually the impact investors and how they can contribute to moving the system forward to what we heard in the morning. This is like I have to sway all the way to here. I was very inspired by Professor Klepper's remarks about externalities, right? And the magnitude of the problem of actually internalizing them. And as impact investors, we really care about helping the system move into that. Also, I was very inspired by Rainer about the planning cycles on the policy side. And living in California, US, you know, we do have our challenges in that country, and I'm inspired by Germany, you know, taking the lead and not seeing it as a challenge, but also as an opportunity, as we heard this morning. And finally, last but not least, as Jeremy Oppenheim points out, the $5 to $6 trillion in infrastructure investments in the developing economy, right, in middle-income countries, and what that really means with respect to cities and what have you. So the reason why we impact investors do impact investing is usually a combination of brain and heart. So talking about these trends, as we have heard articulated so nicely this morning, is something that we try to understand and align our investments with these mega trends and making the world a better place. And the other piece usually is a personal component of impact investing that people like my wife Lisa and I and other impact investors, we don't really see a choice but to align our investment strategies with what we believe in. And so we don't differentiate between the values, how we live our lives, and the purpose in our lives from what we do with our capital or what somebody else does with our capital. We cannot really allow that to take a different road. And so I've been privileged to work with so many impact investors, and Lisa and I and others have co-created global networks of impact investors, one of them being Tonic, which is represented here with many people, and active investors, right, that take a portfolio approach to impact. And a subset of the Tonic folks are called 100%ers. And the reason they're called 100%ers is because they don't hedge anymore. They go all in with 100% of their investable assets. And again, you know, especially the 100%ers, they see impact investing not as an intellectual exercise, but as a way to express the change that they want to see. And it has been inspiring because we're not alone anymore. We're about 100 across the whole world, from Australia to Austria, and Germany, of course. And about $4 billion committed to impact, about $2 billion already deployed, and between family offices, endowments, foundations, high net worth individuals, you know, and all shades in between. Next generations going in all in, not believing the intermediaries that work for the system, that pretend that the system will survive the next 30 years, which we know it will not, right? And so we're just a little bit at the forefront of a mega trend that's natural and not something esoteric, because in the long term, impact investing will, of course, be the only way to go, and we can drop impact from what we do. So with this, I want to introduce quickly, but they will introduce themselves. The panel, I'm privileged to have 300%ers with me on the panel today, and to my left, Jochen, and they will introduce themselves in a minute, and then Lisbeth Peeters, and then Stephen Brenninkmeijer. And what I thought we would do is give them a chance. They could do like 30-minute speeches all by themselves, and very interesting ones, but I will time you out after about 5 to 6 minutes, and they will explain different perspectives, very different perspectives and insights from different venues of impact investing. And then if we have time, then I'll tie a few themes together and then open it up for 2 or 3 questions. We didn't have more time for that, but I invite you to look into Tonic and the networks that we create and have an ongoing conversation over the next decade or so to change the system. Thank you. Jochen.
This one? Yeah. Okay, great. Well, thank you very much for coming, everybody. It's great to have this together the second time, and it's a wonderful event. Thank you, Mr. Turner. At least I get his first name right. He wanted to be called Christian, but he's called Sebastian. So now you know. So thank you. And you say, why are we doing this? Make it personal, you say in big letters, right? So, well, I thought that in being German, being based in Germany, you know, we had many things that we questioned. Why did our grandparents take action to do things when they maybe could have known what's going on and they didn't quite act? Because they had a real challenge. And I think today we do know what's going on. It's climate change. It's a very serious impact that I'm very worried about. My children, grandchildren may not have a space to live if we don't take action. And today the enemy is not Adolf Hitler. The enemy is maybe another Louis Vuitton bag. And even more attractive, actually you can make money now doing good. So it's an amazing change. So when I first met Charly, we used to sponsor Greenpeace, and I used to make money investing in Russian oil companies, and I didn't really see any problem in that. And Charly said, really? I said, no. What's the problem? And then I gradually dawned on me that maybe the oil companies cause cancer by the way they operate the oil fields, and the oil spills into the rivers, and people drink the water and they get cancer. And therefore we decided to divest from fossil fuels and to invest in renewables and resource efficiency. The key thing that happened that's really exciting where we sit today, when we first sat here last year, we had $50 billion in commitments. And our great, hairy goal was to get to 150 billion commitments to divest. And we thought that's really tough. We worked really, really hard all summer. We had gotten the Rockefeller family to commit to divest with all of their wealth. And people said, wow, if the Rockefellers are getting out, I'll get out too. And then what happened were a few things, and these are the things which make it really exciting. I think we're in the middle of a new green Wirtschaftswunder, grünes Wirtschaftswunder, an economic revolution, an industrial revolution, which means that all of us in the room that get it will be the future Rockefellers, the future JP Morgans, the future Carnegies, plus you do good for the planet. And the three reasons are that in Germany, the EU, and Holland, we consume a quarter of the energy per unit of GDP than emerging markets, and if we export that to other markets, we'll cut global energy demand efficiently. Secondly, the renewables have broken through grid parity. So as we had the $50 billion target, a tender happened in Dubai, and it was won at 6 cents per kilowatt hour by solar against oil, gas, coal, nuclear. And for the first time ever, the United Arab Central Bank converted that into dollars per barrel. And they said, only when oil falls below $10 per barrel will I regret my choice to have gone for solar. I said, that's unlikely, I'll go for solar. The whole world thought that must be a mistake. They can't calculate, these Arabs. And even if they did calculate right, then they were just showing off. They're like buying the Qataris bought the handball team that became world champions. So all the Qataris, looking quite German, won the world championship. Similar, not a real price. But BP even sued them, but it turned out they were right. $10 per barrel is where solar was. And even for me, it took half a year to really gather the figure. And as I understood the figure, in Austin, Texas, a tender was held and Sun Edison won it at 5 cents per kilowatt hour. So now guess what? The Arabs know how to calculate. They were smart. They're making a cent more than the Americans. Okay? And that was $7 a barrel. And now, just 3 weeks ago, a new record, 2.99 cents per kilowatt hour. That's $5 a barrel. So if anybody goes out to lift oil, investing more than lifting costs than $5, is going to lose money. So it's no longer profitable. Then people said, but 95% of oil goes to drive. And you have no way to drive. I say, my Tesla is great. It goes from 0 to 103 seconds. It uses a third of the energy, a third of the maintenance cost. But it's 150,000 euros. It's not competitive. It's never going to happen. And the portfolio company of ours called the Mobility House had a crazy ideas 5 years ago. They come from the pump storage business. They used to take water from the bottom of the valley, pump it up, as we heard earlier today, at low prices, and then pump it down at high prices and make money. And the Siemens team thought this was too slow for them. Let's do it with lithium-ion batteries, where I can do it in nanoseconds, and let's use electric car batteries. And this was a crazy idea 3 years ago. And last fall, they did a joint venture with Mr. Zetsche, Mr. Michael Ludwig, and Mr. Thomas Raffan are opening a joint power plant based on electric car batteries. And that electric car battery is now making 2,000 euros a year, when the car costs you only 25,000 euros. So here's the proposition. You go buy a car for 25,000 euros, and every year I get 2,000 euros back. And we're all finished here already. Anyway, as a result, we're in the middle of a great new industrial revolution, and it would be great fun if you could help us and join that revolution. We need capital like yourselves to move into it, because the big pension funds are ready to go. And with just 20 billion euros, I think, in equity capital, we can stop all of German emissions, given the leverage in today's market. 220 billion equity gives you 200 billion in debt. Do it 5 times, you're at 1 trillion. Do it with profits, you're at 3 trillion. You've eliminated all of German emissions just by starting with a bit of money from this room here. So let's do it. Thank you.
Jochen, thank you. How big is the Divest Invest movement right now, globally speaking?
The bottom line, forgot it. So we wanted to get to 150 billion, that was really ambitious. We got to 3.4 trillion. So instead of tripling, we 68 inglixt, whatever that means. 68 times more commitments. And every day people are signing up. You go to divestinvest.org and you click and say, I will divest. And each of us is an investor. You have a bank account, a savings account, you have €5 on it, you are an investor. And that investment money has an impact. So ask your bank to put it into green things. Don't let it finance things that cause cancer and are stupid to invest in. Thank you.
Great, thank you. So impact investors take a portfolio approach to divest, invest, and also climate change mitigation and other themes that they care about, right? And so that means that in fixed income, they go into green bonds and what have you. In real assets, they go into renewable energy, they go into renewable timber, biodiversity, carbon offsets, and have been doing quite well on the financial side as well on that one. And public equities is dicey for a lot of impact investors because unless you vote your proxies, it's hard to make a case that you actually contribute to the benefit of the planet. But there are many opportunities to also influence that with what we would call ESG++, which would be the low end of what impact investors care about. And the impact themes are all across these different themes. And so Lisbeth is going to talk to us about some of these themes in the context of the emerging economy and what that really means for impact investors and the environment and the bigger picture of investors.
Great, thank you, Charlie. Thank you, everybody, for having me here. My name is Lisbeth. I'm a partner at D Capital Partners. We focus on impact investing in emerging markets. We're part of the Dahlberg Group. And a little bit about my own personal journey on getting to this stage. I spent about 6-7 years of my life in finance, the investment banking, private equity, mainstream capital markets. And through my graduate studies, ended up and finding myself in rural Côte d'Ivoire for an internship where I was asked to explain how to set up a credits and savings union with the poor people that were being unionized in the factories that were processing palm oil and coconut and pineapples back then in the days. And this was in 2003. Some of you might remember the times of the dictator Gbagbo, who was governing the country at the time. So I was the only person going back to her second year of MBAs without getting paid, but with pictures with my presidential bodyguards in the background. And soon was I to realize after 2008, all of a sudden I became the envy of my classmates because I was doing some really, really cool things. But what was most important was that during that internship I learned the power of my finance background. Going back to the villages and actually explaining to people the basic 101s of finance were sort of like where it dawned on me that, like we could use our tools and our skill set to a much better, and greater thing. And so over the last 7 years, I've used everything that I've learned on Wall Street and in the City of London for, advising impact investors, people like yourselves, in putting that money to work in an emerging market and a developing country setting. One of my clients is a family office, small family office in London, very focused themselves on renewable energy. And when they asked me, well, we're not really sure that access to energy is the right metric to use in a country, like in Africa. We think it should go further. We don't really see the impact, per se, of providing people just with electricity. Like, shouldn't we be measuring the offset of carbon footprint and the differential of what they're using right now versus what they will be using if we give them a solar panel and this and that? And my response to them was, how about you just switch off the main switch of your house electricity supply for a weekend and see how your children respond in what the power is of actually having power. That's the difference between the life of a child in Africa and the life of a child, like in Hampstead Heath. And we never had that debate again. Now, over the last few years, there's been a lot of movement in the energy and renewable energy debate around emerging markets, with big players like China having discussions with governments and coming in, but also governments like the US. We've got USAID with their Power Africa initiatives. We've got the African Development Bank with large money, like looking to be deployed, etc. And one of the things that I, would like to highlight here is the, obvious tension. A lot of governments that we work with and a lot of business people that we work with are all in favor of coming up with more renewable energy sources. But at the end of the day, what they are most concerned about is the plain access to energy and how that is being distributed across the populations, most of which are still living in rural situations or in urban settings in a very low income, situation. And so, it's important to keep that tension in mind when you're thinking about your role into emerging markets. Having said that, one of the very exciting examples that we have seen of how impact investors have moved the needle is in off-grid solar. The off-grid solar market about 5-6 years ago had a number of random entrepreneurs coming up with very exciting business models. They're the likes of Mkopa, Mobisol, Off-Grid Electric, Phoenix Capital, and Simpa. Fast forward 5 years, each and every one of them is currently in discussions with large-scale debt providers for debt facilities of more than 20 million into their companies. And obviously this couldn't have been happening, or this couldn't have happened if it hadn't been for the operational teams that have built these companies. But most importantly, it couldn't have happened if they hadn't had the equity investments from impact investors that back 5 years ago bought the story of lightening Africa or lightening India and buying into them and putting the money down.
Thank you so much, Lisbeth. Yes. So we heard, the success stories of small investments of impact investors that then go to scale, and how that actually enables big money to follow and come in. A very, very great way of seeing how the ecosystem evolves. And many of these investors, are coming from, like I said, family offices and high net worth individuals. As a matter of fact, Tonic is documenting now 50 plus portfolios of 100%ers to show that this is really now moving into a movement, not just one or two. So it's not only 3 or 4 of the visionaries, but we're going into the innovator phase, into the early adoption phase, particularly as we talk about climate change. And impact investors are, of course, also motivated in complementing climate change with social justice or injustice and inequality, which are ultimately linked to each other and not separate, right? And but the family offices play a huge role in activating money. And so Stephen is going to talk to us about, his family office and his observations about that, and then in his role also as participating in a couple of foundations as well. Stephen.
Thank you, Charlie. Yes, thank you very much for having me again. I was here as well last year. It was very inspiring and very interesting to be here. For us as a family office, the whole topic of divest invest is I think is a challenge still at this point. We look back as a family business of 175 years of being in business, and obviously with us, particularly in the investment sphere, things probably move slower than with others, because obviously we will really take time to assess it. And so I'm very pleased being here, because obviously one of my roles is also being a board member on the European Climate Foundation, who is also, let's say, I think very active in that field. And I think through my engagement there, I can help steer some of the discussions internally. Within our concept and within our structure, we obviously do a lot of philanthropy as a family as such, but we also do venture philanthropy through a foundation called Attendees. We do a lot of work in sustainability through a foundation called Good Energies Foundation, and that is actually for us the key area where we would very much look at divest invest, because this is an area where we very much look at sustainability of whatever we do, and that also filters down into, let's say, our one of our main businesses, which is CNA, the sustainability of report of CNA, the CNA Foundation, is quite remarkable that they just have published. So I think it filters through, but we haven't, as an organization, yet signed Divest Invest to be part of it. I'm working internally to get that done, but okay, as I said, these things take time. And so in that sense, from my perspective, it is a very exciting place to be. If I look at the European Climate Foundation, who is also a sponsor here today, and I think the work that the foundation does is very much in line of Divest Invest, but what they want to really achieve is create a, let's say, a new mindset within the industries. If you look at the cement industry, if you look at the pharmaceutical industry, transport industry, etc., steel industry, it's not so much of selling assets, because obviously they say very clearly, if you sell an asset, there's a buyer. You know, for us, it's much more important, they say, actually, that we actually help businesses to change. So it's not the point for Shell to sell an oil rig to somebody else. No. How can we help Shell to actually decommission an oil rig, as an example? How can we help the cement industry to develop systems of how to produce cement in a more sustainable way? It's not only the energy they're using, it's also the chemical aspects of the cement. So I think there is a lot of effort that needs to be done in the next 10, 15 years. But I think organizations like the ECF and Climate Works and others are very much on their way in that field. And that plays very, very much into the discussions that Divest Invest has. And I think, again, I'll take it back internally to discuss it and to share the experience there. So I'm pretty sure that in the next 5 years, we as a family organization will also be part of this movement, because we see it as, I think, the only way forward. And if we look at the children and our grandchildren, obviously that's exactly what we need to do. Okay? Yeah.
I've been asked to officially announce that while you're being very humble, you were also very kind yourself with your own investment vehicle to step up and support the Divest Invest movement with your own investment vehicle. And therefore, Stephen was one of the people that was awarded a prize that was awarded to the Divest Invest movement by the Nelson Mandela and his wife, whose name is difficult to pronounce, Garza Machel, I think. Yeah, no, his wife, Garza Machel. There was a prize that Stephen and 135 foundations won, which is Nelson Mandela and Garza Machel Prize for Bravery in the NGO world. So congratulations, Stephen, for having yourself done it, and thank you very much for pushing it forward overall. Thank you.
Thank you. Which shows, right, that again, Divest Invest and making these commitments is not black and white, and we impact investors are not naive about the investments that we do. Each investment has a positive and a negative impact, but we demand transparency, and by sharing our due diligence and trying to maximize the positive and minimize the negative, right, we believe that we can actually change the system. As part of our 100% community within Tonic, for instance, vis-a-vis the Divest Invest movement, we have about 60%, signing up either personally and or with their entity, business entity, to Divest Invest. About 20% are looking at that, and about 20% are actually not signing it because they want to continue to invest in the transition and participate in that. So you see again the diversity of opinions and the diversity of moving the needle. I think is a collaborative approach across different ways of doing things. I am very proud of the panel that we are actually still having 10 minutes and 59 seconds, because that was the goal, to engage you now with such an inspiring panel to ask questions. So I ask you to stand up and identify yourself, and then if you have a question for a particular person, just ask it to say this is for Stephen or for Lisbeth or for Jochen or for myself. Otherwise, I will direct your questions. Okay, while you're still thinking, we're obviously in Germany. Is that a challenge, hopefully? Okay, as opposed to an insight? Okay, all right, good. Just seeing if you're still awake. Here we go.
I didn't want to be the first one again, that's why I was hesitating.
I do have my own questions too, but I figure yours are better.
I think this movement is a very good one, but the question we had today was Jeremy's presentation is, how do we come from A to B? And the question is, how do we get into the small infrastructures? I mean, this is a basic point, and I think you made some comments on, for instance, off-grid solar and stuff like that, so probably you could answer a little bit more how we could help to make this more possible, because we heard also that we need some political framework, and I know that is always very difficult because the political conditions are much slower than industry can be normally. So yeah, it would be nice to have some hints from you on these issues, and all of you have something to say on that, so I cannot address it to one of you. Thank you.
Yeah, I think it's a very, very valid point that especially in the emerging markets, there is a strong need for political dialogue and helping these countries and these governments set the right policies and the right frameworks. And I would say it's unfortunate that we see a player like China coming into some of the countries in sub-Saharan Africa with a lot of foreign direct investment that we don't see on some of the other bilateral governments that are coming in with more of an intake of the strategic dialogue. And so, you know, like my call for action for anybody would be that if you go into these markets, you need to have the political dialogue as well as the FDI strength to do that. You know, like Charly and I talked about, it's a strategic investment, and therefore you need to make that investment, put your money where your mouth is, as well as help them set the political framework. Having said that, so we invested in the first biogas plant that was off-grid connected to the grid with a private IPC off-taker contract in South Africa, not necessarily the easiest of political environments, one can say, with BMW being our off-taker. They waited for, you know, like the electricity to actually go to their plant just outside of Johannesburg for about 3.5 years, while the investee company, together with the board, set all of it in place. But it happened. And it happened even within the vacuum of there being the, you know, like actual grid, you know, like regulation in place. All of those things are very small token examples and cases of the things being built that will be used then to catalyze the rest of the environment, especially in places like sub-Saharan Africa. The business sector and the private sector are not going to wait for the policies to be put in place, and they can, you know, like afford that luxury, but the two need to go hand in hand. And so the small cases, you know, like are starting to be there and need to be used to amplify the political dialogue.
Maybe based on that responsibility is also a sponsor of this conference, and I happen to be also a board member, and we are very much engaged in building hydropower plants in sub-Saharan Africa in conjunction with KfW. Again, it's a 5-year project. Substantial amounts of money are flowing in, but it's happening. So I think that is a very good sign.
So maybe for Germany, where are we today? If I was Elon Musk, we Germans would say we open source the solar to the world, so the whole world's now got very cheap solar. So it's a present we delivered, but it would be very nice if, unlike the British Empire, which benefited from the first industrial revolution with the steam engines and became a global power, and then missed the next industrial revolution and it passed the buck to the Americans, it'd be nice if you have invented a new industrial revolution, you actually benefit from it and you don't become a laggard and industrial wasteland. So Germany really has to now take the right decisions. It's difficult for the traditional parties, unfortunately. We have a feed-in tariff law, EEG, which if you start saving too much energy as a producer in Germany, you actually get penalized and pay a much higher electricity price. That's about as intelligent a law that I come across. And then on the other side of the spectrum, of course, you have people who are trying to defend the combustion engine car industry, which in fact has no future. They cause cancer, they're slow, they stink, they make noise, I mean, endless list. And you just have to switch. And what you need to do is you need to allow the feed-in into the grid. I think if that happens, that would be great. But of course, what we heard this morning, as an economist, it's always the same. We have to have a price on carbon. And I think that what Mr. Barker told me just afterwards, they said, yes, we should simply not allow auctions of CO2 emission trading certificates below 30 euros anymore. And if there's any in the market, we should buy them up. And that's very, very important. And if it means buying off the poles, which apparently are vetoing the stuff all the time, let's buy off the poles. And the great idea that Mike just, if I may, came up with, he said he's got a great idea for Germany. How about we cut the income tax by 50%, so if your top rate is 35, it goes down to 17%, and we replace that with a carbon tax. Would that be attractive to you? Would you vote for that? So let's do that. Let's cut the income tax, individual income tax, and replace it by a carbon tax. What does it do? Those people that waste energy and kill the planet pay the taxes, and we pay less taxes. So with these concrete steps, let's do it.
Okay. Thank you. We have a question way back there, and then I move forward. Yeah.
So I think all of us are thrilled with this, Jeremy Oppenheim, with the development of the impact investing industry and the role that it can play in catalyzing, deeper change. Obviously, one of the challenges is that impact investors, in some ways, at least the picture one has, is that that they're willing to take some discount from the, if you will, normal market returns for the risk, in order to get a social or an environmental return, and that can, of course, be discouraging for mainstream investors. But my guess is that all of you have experience where, in fact, you're breaking the trade-off. You're demonstrating that you can deliver not just, if you will, the environmental and social returns, but you're demonstrating that you can deliver the economic and investor returns for the risk as well. Yes. But what's missing at the moment is data. Really good, transparent data that's systematic, that's not just the one-off brilliant thing that Good Energy did or whoever, but systematic, properly analyzed data. So where does the movement stand? Who's helping you do it? How do we get this data out there that can really demonstrate systematically that this impact investing story is in fact one that can actually generate economic and social and environmental returns in parallel?
If I may just try to answer part of that question. Last week, a book has come out, a 300-page report on a guide to impact investing, which includes data on portfolios of many impact investors, including quite a number of tonic members. It's written by Giulia Ballandina, and it's the first time, Tonic has been advocating this for a while, but including the Charly and Lisa's report on their funds, which proved to be higher than the benchmark. So I think the proof is already been given that the economic return can be even better than the traditional returns. So I'm not the writer of this book, but just happen to be also one of the people profiled in it, as well as Charly and Lisa and Stephen Brenninkmeijer and 10 other Tonic members. And it includes the entire portfolios plus their performances. So I think the idea that the data is not there is just past. That was true maybe 5 years ago, but it's not the case anymore. I think the proof is there, but people are still hesitant, and the way I see it is that it's generally the advisors that don't really know about it and are hesitant to help their clients do this, and the networks, I think, including the PIM-WIMIC network and the Tonic network, they can help to give the support that is sometimes lacking from the traditional sources.
Just maybe one more comment. We launched an impact fund called, our family office launched an impact fund called Scopus 2.5 years ago. And Scopus has commissioned Wharton Business Schools to do exactly that. What Julia also has done to actually assess what are the data in impact investing. And they focus on exits, obviously. So, and that publication is public, comes from Wharton Business School on that. So I think there's a lot of data available.
And it's a fact set that we need to build, right? This industry has only, as an industry, started come together about 5-7 years ago. I would like to just mention one more effort done by the OECD, has now become the academic partner of the G7 Task Force for Social Finance, and has also started very systematically carving out and digging through data to build up that fact base.
So we don't get up unless we try to go for 20% equity returns, and the previous fund, the Green Gateway Fund 1, has tripled returns in 3 years and got an IRR over 20%. Longer duration stuff my father's been doing, got 20% return, even though he says his target return is 6%, anything else not serious. excluding divest fossil fuel companies from his portfolio. So yes, you can make money and do good.
So having said this, there is a lack of data, and the more data we can provide, the better off the industry and the ecosystem will be. And there's many efforts going on from many different networks. And our foundation has published a report 1.5 years ago that has shown that we outperformed over 7-8 years. A weighted benchmark. Our S group out of Hong Kong has just published about 3 weeks ago a report on impact and financial return. They outperformed the market with a 100% portfolio. And we know of 2 or 3 more reports. And Tonic is working on a more comprehensive report for this fall. I think we'll have one more question and then we'll have to end. I saw a couple more questions back there, so please. Or if you have 2, 3 questions, maybe we can answer 2 or 3 more. So let's listen to the questions first.
Okay. Yeah. My question is about the development banks and also our family office. That, for example, in 2 days in Beijing there will be a similar forum. It's called One Belt, One Road, Sustainable and Responsible Forum. And I would like to listen to the panelists, your views about the role of very big players like the institutional investor like AIB or World Bank, and also the role of family office, how they can, cooperate on one hand, on other hand, how they differentiate themselves. Thank you.
I'm going to channel it because we're running out of time. So.
Quick questions to you as investors. Are there enough targets and good companies and managements out there that you can invest in? Or is there sort of a degree of like...
And one more question, and then I wrap it up within 3 minutes. Okay, done. So with respect to the development banks, they play a crucial role in scaling up, right? Because we need absolutely... I wouldn't call it subsidized capital, but capital that unlocks private investors. And that's the role of in OPIC and DFID and others are understanding that and are coming in. KLF, our foundation, has done 2 investments with OPIC, right, as one of the development banks. And I think it's a necessary move because we bring the innovation to the table, they bring the scale to the table, they then unlock the bigger capital. With respect to targets, anybody wants to talk about deal flow out there? Otherwise, I would summarize my...
If you focus on resource efficiency, anybody that's more resource efficient becomes more profitable, and that's also good for the environment, and therefore the universe is infinite. And then within that infinite universe, you look for decent people who have high moral standards, that want to do more than just, would you sell your grandmother for a nickel? What's the answer? What's the exchange rate, right? That's the... So if you wanted... I've just been to the fund forum here. It's a fantastic group of people, these bankers. I used to be one as well. But no, there's a huge amount of good people out there, and they seem to be more resilient in stress tests, right?
I think in the regard of deal flow, if you look at the microfinance industry, which probably was one of the pioneers in impact investing, I think there the deal flow is much more complicated and difficult, and probably not so much anymore because I think that industry really has matured. But I think there are enough other deals out there, and so I think this, and there are a lot of creative people around in that industry who actually are very, very creative in packaging certain deals together. So I think there's still a lot that can be done.
My only final comment would be you invest in talent and in people and not in deals or in companies. And so it's up to you as an investor to have the patience to also make sure that these people and these teams develop and manage to reach their true potential.
So thank you all. You can see that we have a lot of fun and joy debating the impact that we have, and that's usually goes way beyond the fear-based checking and debating of how you lose money in the dying economy. And so join us in actually investing in the future of the planet and humanity. Thank you very much to the panelists and to you.